You see, the convenience store offers an excellent example for illustrating the difference between markup and margin, because people often mistake the two. What you don't want to do is manage according to markup. Instead, you want to manage according to margins. So in this case, in that particular transaction that we just did, the store owner might have paid $1 for this piece of candy, but I received $2 for the sale. The markup was 100%. I mean, after all, $1 is 100% of $1. So the markup was 100%. The margin, on the other hand, was 50%. Why? Because if we earned $2 worth of revenue, $1 was our cost of goods sold. The difference is $1, 50% of $2. So we want to manage according to margins. So what do you do if you're selling a mix of product with many different margins? For example, beer could be a margin of 18%, whereas candy could be a margin of 52%. And so how do you manage it? You want to focus on total gross margin. How do you track these? There's a variety of ways. You can get spreadsheets for it, and there's also some, you can use QuickBooks or accounting software, but that tends to be pretty sophisticated. Or you could perhaps use something from EDS, for example. EDS is a software company, and they have some pretty good industry-specific margin management software. That's it. If, like the convenience store, you're selling a mix of products with a lot of different profit margins, you've got to concern yourself with how each one of these contributes to the total gross margin. In other words, the proverbial bottom line. So, let's say that we're talking about beer. At a contribution margin of 18%, may account for 30% of total sales for the store. So that's 18% times 30%. In other words, 0.18 in the calculator times 0.30 in the calculator equals 0.054. In other words, between 5 and 6% of the total gross margin, or bottom line. Candy, at a contribution margin of 52%, may account for 35% of sales. So that's 0.52 or 52% times 0.35 or 35% equals 0.156 of total gross margin. In other words, it's between 15 and 16% of total gross margin. Take that 0.156 and set that aside for a moment as well. Tobacco products and other items at a contribution margin of 23% may account for 35% of sales. So that's 23% times 35% equals 0.0805 of total gross margin. Let's take all these margins and add them up and see what we come up with. So that's 0.054 plus 0.156 plus 0.0805. That gives you a total of 0.2905, or a total gross margin of just over 29%. We call this the weighted average contribution margin technique. Large retailers, such as this one, practice this on a much grander scale. If a convenience store owner must do all this manually, then a larger retailer, they have buyers, and buyers are responsible for an entire section of store. Whether it's a department store like this or whether it's a grocery store, it's the same thing. Therefore, they're always watching this combination of margin and how fast something actually moves or sells. So, if there is a product that may not be moving as quickly or the margins aren't quite as good, if you want to get your product into that store, that's your opportunity. Now you know the difference between margin and markup. Don't confuse margin and markup. You want to manage by margin. You want to manage by the contribution margin of every single item that you sell, and you want to go ahead and take the average of all those contribution margins and keep the whole gross margin within the range that you want to keep it in. The gross margin is the total average margin. It's like a group photograph of everything that you sell and all the profits that you're making. What is a gross margin for your industry? Well, that's available through places like the Risk Management Association or bizminer.com. Now, those are subscription-based services, but you can get this information for free from the Small Business Development Center. If the gross margin is like a group photograph, the contribution margin is like an individual photograph. So manage the contribution margins and keep them as high as possible so that they bring up the overall gross margin average.